One of the great debates on the market today is whether or not Nvidia stock is overvalued or not. And you can make a phenomenal argument either way. But I wanted to take a step back and look at historical context here because we've been through this before. And I think one of the best comparisons to the current state of artificial intelligence is to the internet bubble in the late 90s. Now, there are a lot of differences between the two. Most of those companies were unprofitable. Today, a company like Nvidia is very profitable. But there's also a lot of similarities. You had a very undefined market. You had disruption that was growing like absolute crazy without any sort of real solid business model behind it. People were using the internet more, but the Amazon that we have today, the Shopify, Ubers, none of these companies existed. None of this technology existed yet. It was just people going online and looking at stuff. They weren't even necessarily spending any money. So one of the reasons that the dot-com bubble popped was the stock valuations got out in front of the actual business reality. And this happens over and over again, especially in technology, where you see growth years or decades ahead, and the valuations just simply get out in front of the business itself. So I wanted to take a look at the historical context of where Nvidia trades today compared to some of the successful internet companies and where they traded not only in the late 90s, but also during the great financial crisis and leading up to that time. Do we have any historical context for a company trading for 40 times earnings and still being a very good investment over the next 5 to 10 years? And the reality is we really don't. So that's what I'm going to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first thing I wanted to pull is the enterprise value. So that's going to be the equity value plus any net debt that a company has. Most of these companies don't have a lot of debt, so that debt side's probably not as important in this. But I wanted to take the full valuation of the company and then divide it by sales. And this is information from Y-Charts. Goes all the way back to the 80s with Apple. And you can see that I pulled Apple, Alphabet, Amazon.com, Meta, so Facebook, and Tesla. There was only one of those companies that ever traded for 40 times sales. That was Amazon in the this was actually very early 1999, and then for a couple of short periods later in the year. But what happened to Amazon stock over the next few years? You can see that here. Amazon dropped about 90% in value between early 1999 and late 2001. This was still a phenomenal growth company. In early 99, they were growing at about 280% per year. 280%. That's faster than Nvidia is growing right now. And that growth rate only dropped to about 45% a couple of years later. So still a phenomenal growth company. But what happened was multiples compressed across the industry. And this is really the thing that I think we need to keep in mind right now. Nvidia's business can be phenomenal, can be growing at a phenomenal rate. But if you're paying a high multiple for a company, that is pricing in future growth. And hopefully you can grow into those multiples. The problem from an investor standpoint is if a company doesn't grow into those multiples, or there's any disappointment, if there's any sort of earnings miss for Nvidia, then you can get into a phase where you're going into multiple compression. If multiples go from 40 times sales to 5 times sales, the stock is going to drop to 1/8 in value if everything else is equal. So this is really the risk, is that you're paying a very, very high multiple for a company that is going to have to then live up to that multiple. Well, think about Amazon.com. They lived up to that multiple, but it took years. Same thing for Microsoft. This one may shock you with Amazon. Amazon peaked over a split adjusted $4 per share late in the 1990s. It didn't reach that level again until 2007. 2007. By then, AWS had been started, Prime had been started. This was a very, very different company that grew a ton between 2000 and 2008. But as an investor, you still would have been flat on your stock over that period of time. So this is the kind of context that I'm trying to put into Nvidia's price right now. Let's look at Microsoft. Microsoft's path was even longer. You can see that the stock price peaked in the early 2000s and didn't get back above that stock price until 2016. Over that period of time, Microsoft was no slouch as a business. Revenue was up 430%. Net income was up 250%. Just consistent growth year after year for Microsoft. And still, it took a decade and a half to get back to that valuation that wasn't even 40 times sales. Another interesting one is Cisco. Cisco was really the dominant company in the late 1990s. Just phenomenal business, extremely profitable. Their growth lasted well into 2000. And you can see here that net income was really solid and grew for years after the dot-com bubble. But what happened to the stock? Well, the stock never got back to its dot-com peak. Still to this day, it has not gotten back to that dot-com peak. So there is really no historical context for a company trading for 40 times sales and then living up to that in a short period of time. Amazon eventually did, but there are plenty of examples of companies that traded for multiples like that and then never got back to those peak levels. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, short-term stock could double again over the next 6 months. It's very possible. Valuation on a short-term basis is not typically what drives stocks. It's really more things like sentiment and short-term investors are feeling about a company. But I do think it's important to think about the historical context for a company like Nvidia. Even companies that came to define the internet, which was really just starting in the late 90s, took a very long time to live up to the growth expectations that a lot of investors have. Like I said at the start, a lot has changed. Nvidia is a very different company than Amazon.com was in 1999. But that doesn't mean that paying 40 times sales, which actually has adjusted over the last week as the company reported earnings. Right now, Nvidia is actually only trading for 32 times sales. But all of these companies were growing at extremely rapid rates when they were trading for those really high multiples. So it's easy to say, yeah, but they're growing at 40, 50, 60% over the next 3 to 4 years. But the problem is all of that growth is already priced in when you're paying a multiple like 40 times sales. So I'm not somebody that typically thinks about valuation all that much. I want to buy phenomenal companies and own them long term. Nvidia has been a phenomenal company. But it is important to understand what you are paying for that company, what your entry price is. Now, if you've owned shares for years, great. Just leave it. Take your profits. There's going to be volatility along the way. But if you're looking at buying shares of Nvidia today, I think this is a very, very high price to be paying. And historically, there is no precedent to this working out well over the next few years. It could absolutely be the case that Nvidia does extremely well over the next few years. It could be the case that they grow into this multiple over the next 5 to 10 years and the market still continues to think that this is the best AI stock. But history says that something is going to change. Something is going to bring these multiples down. Something is going to bring competition into the market. Cisco was the hottest stock around in 1999 and 2000. Now, we don't really think about Cisco a lot. Amazon took years to live up to the multiples that it had in the late 90s. Microsoft, one of the companies that came to define the PC era, took 17 years to grow into its 1999 valuation. Understanding the history of the market, the history of bubbles that happen is really important. And hopefully this history and context is helpful when you think about Nvidia. I have no idea where shares are going to go short term, but my worry about the stock is just simply that there's no historical context to this working out well for investors. But what do you think? Do you think that any of this historical context is important when thinking about Nvidia? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.